Okay, traders, let's have a little look at the US non-farm payrolls. Now, I've seen some sort of pretty average sort of trading going on this week. Not by everyone, but, as we have these big events, right? And this is what you've got to understand. Every week, there's usually one core theme. And I can tell you, the first week of every month, it's the US non-farm payrolls, right? It doesn't take a rocket scientist to work that out. So everything that happens leading up to the week, there's a bit of jostling. There's a bit of, market positioning or corrections around what's going on. Now, just having a look across the global markets here, you can see the dollar index has got a very clear upbeat direction, right? Gold's coming off, oil's under pressure. You've got the equity markets, of course. I mean, once again, the cycle of up and down, they're under pressure as we get a key, what I would call a kicker, either inflation or employment numbers, because it has implications for interest rates, right? That's the key part to it. Now, the crypto is just hanging in there. Bitcoin looks like it wants to go high, but just hasn't got the drive. Commodity index just drifting lower, mainly due to oil falling over. So just having a look here, right? And just coming back into the currencies, because the currencies are very active at the moment and they are trading technically very well. You've got, if you're sort of wondering, how are they going? What should I be trading? Well, your charts will tell you, right? And the dollar, like leading into the non-farm payrolls, it's bid, right? And what that means is it's going up, okay? It's got an upward bias. So that's very good for us. And that's one thing that you need to take into this release is, right, the dollar's got a strong bias. Why is that? Well, the assumption is we're going to see some really good US numbers, right? If I come back here just to, once again, have a look at the equity markets. So there's two major asset classes here, the currencies or the dollar against other currencies, and the equity markets are very much in play. Now, one thing about the equity markets is, okay, the market's going to open up after the data, right? An hour after the data, and then it's going to sort of really kick into gear. Of course, the futures will be in play, but so you've got to work out what are you potentially going to be trading, right? If it's the equity markets, you're probably trading equity futures in the lead up to the release, and these will move very aggressively on the release of the non-farm payroll numbers. So this is the variables we're going to look for. So when you come back and you're thinking, okay, yeah, it's all well and good to know what's coming out, but it's another kettle of fish to actually go through the various instruments and asset classes and trying to work out where the best trading opportunity is. Now, I've said this 1,000 times, and I'll continue to say it, that the instrument best to trade is the one with the best technical setup, right? It just makes sense, because what that does is it allows us to hit the market with the rest of the market at the same time. So you generally know when momentum's going to kick in or kick out, etc. So you're trying to have a look here. Now, with the currencies, right, a lot of them are a long way from any sort of decent levels. So it makes it a bit harder. So if you've got a favorite currency and you're like, yeah, I like the dollar or whatever, well, then you need to factor in your plan around where the currencies are. At the moment, they're all under pressure. So what does that do for us? Well, it gives us a couple of things. If they're under pressure, right, there is a potential here for, if we get weak US numbers, a major correction here across the board on the euro, sterling, Aussie, Kiwi, and we could see the dollar just drift lower back down towards support, or even break it, depending on how weak the numbers are, if the numbers come out weak. So to me, a strong number is factored in, right? And this is where you start to come into play and really get your nose into the actual numbers themselves. Now, the key part to it, for those that sort of aren't aware, I'll just sort of run through this. It's all around the expectations, right? The good thing is you've got a low and a high of the variables here. The low number expected is 230, the high number 350, right? So the number we're looking for is 290. So a perfect scenario here, right? Are the really strong numbers, because that gives us a really big kick to the top side. And don't forget you've got the unemployment rate here, and keep an eye on the average earnings there as well. So you've got a number of different variables. Now, what we're really looking for, if we're looking for a strong number, you want it above 350. Okay, that and with that, if we get, say, 3.5% or 3.4, you're going to get a very good dollar move to the top side. Okay, that's just the way it is. And if we get a weak number here, less than 290 and definitely below 230, well, the dollar's going to go down. And if this number here blows out to say 3.6 or above, we're going to get a very solid move to the downside. Now, they're the numbers that we're looking for. That's the forecast. So you got to have it in mind. If you go into the numbers here and plan on hitting both sides of the market, it's very hard to think rationally when you've got, say, three key variables that you're trying to focus on. Okay, the non-farm payrolls, the unemployment rate, average earnings. You're trying to work out, okay, are these all strong or are these all weak? If you're trying to think on both sides, it's too much. You almost need a buddy to be sitting next to you going, you concentrate on weak numbers, I'll focus on strong numbers. And if you see something, especially outside the general ranges here, well, we're into the market. But we're not just into the market. You want to do two things, right? You want to find the instruments that have good technical setups and go in with those. If you have instruments that don't have any good technical setups, well, you might go into the trade with a small trade size, or I would encourage you just to sit back and wait and watch, right? A good number is factored in, right? So a number, I would say 290 or above, closer to this is factored in. And this is what you get from looking at the market, okay, at the technicals. Yeah, well, really strong numbers are factored in. So what we need to get this thing really rocking to the top side is we need a number much or bigger than 350, right? That's definitely, and a number, okay, probably lower or at 3.5, and a higher average earnings would do the same thing for us as well. So they're the three positives factored in. So what happens if the number comes out at 290 or less? Well, it's probably going to drift lower, right? And that's not dramatically. If it's much weaker than 230, yeah, then it will shoot lower. And if the unemployment rate blows out a bit, okay, and the average earnings are weak, well, those three things will line us up for a move to the downside. So trying to factor those three things in is problematic. Liquidity, okay, will disappear at the time of the release. So you're sitting there and you're looking at your MT4 machine or whatever trading platform you've got, and you can see the price action. You're like, yeah, this is great. This is great. All of a sudden, a couple of seconds before, the pricing starts to widen out. That's because all the banks who are providing all the liquidity pull their liquidity a bit. They leave a little bit in there, so there's a few prices, and then you get the gyrations. Now, this is what you've got to be aware of. And I know a lot of people and traders and businesses really punch in and say, oh, watch us trade the non-farm payrolls. But it is problematic because if you get an extreme number on the non-farm payrolls, and then you get a big change in the unemployment rate or average earnings, you'll see a whipsaw price action, and you can get cleaned up on the top side and the downside, and it's back to where it is before anything happens. So this is where you need to, okay, put this together. So what are you trying to tell us? Okay, so to me, like, strong numbers are factored in, right? And there's no real levels on the downside here in Aussie, Sterling, Euro, Kiwi. There's nothing on the downside. So if we get really strong numbers, it's going to drift lower, right? So you might see initial knee-jerk reaction down, then come back a little bit. I would be trading a smaller amount with the trend because we don't have clear entry levels. But if we get really weak numbers, well, there are potential opportunities. And don't forget, there's varying levels of strength or weakness. Say, for instance, we get a slightly weaker number, say like 270K, right? You might see an opportunity to get into some of these currencies on a bounce, okay? You might see a little rally in euro down. That could be the opportunity. Now, you don't know until all these numbers come out. So when the numbers do get close to being released, you've got to have a very clear plan of what you're doing and just be calm, right? Breathe. Just look for the numbers. There's no rush. There's no prize for getting in with the most volatility. The prize is coming from getting direction, getting into an instrument and going from there. The non-farm payrolls will give us the setup for CPI and the next interest rate move from the Fed. The only unfortunate thing is there's so many variables. There's like 6 key things coming out here, right? So if there's one or two that are out of whack with the others, you get that discombobulation. Markets factored in strong numbers. So to me, the opportunity is a weak number is probably the best opportunity because we know where the currencies will correct to, right? So as I said, the main part is picking your poison, whether it's the equities, the currencies, or maybe even the commodities, right? A lot of the commodities are against the dollar. So if the dollar's doing something specific, we know what to do with commodities and all the major currency pairs or the equity markets, right? It's not the be all and end all. Inflation is, but this is its next big buddy that you need to be aware of. It's a major market event, and so something worth paying attention to. Don't believe the hype out there that this is the easiest, the best number to trade, because it's not. Okay, if the markets are trading good like they are at the moment, unfortunately we don't have close technical levels. Then yeah, if we get trending markets and these numbers are all strong, okay, we get a lower unemployment rate, we get higher average earnings, we get a higher non-farms, the dollar keeps rallying. But I tell you what, I think it's factored in, right? So anyway, see how it plays out. I think the downside is a better opportunity just because it's a cleaner trade. If we get strong numbers, the dollar's going to keep rallying, but there's no real levels to get in. So if you are looking for that smaller trade size, if we get weak US numbers, well, then I think you can go in with a bigger trade size either, and depending on the level of weakness, we might see a very strong correction, right? If the number's under 200,000, the unemployment rate's 3.6 and average earnings are down around 0.2, means the market is stalling. It's done. We should see, euro up 100 points and the rest of the pairs about the same, right? So that's it for me. Just a word of warning, obviously, it's not easy, right? So pace yourself, have your plan. Most importantly, when you go into these numbers and understand what the forecast is, okay? So that makes the job of interpreting what to do much easier. When you go on with your plan, right? So say the number here, and you're looking for a weak trade. The number doesn't come out at 290. The low end of forecast is 230, and it comes out at 150, right? You're looking to get short. Don't start increasing your trade size just because it's weaker than the forecast. You're already looking for a weak trade. You've got your plan set. Stick to that. Don't double up the trade just emotionally because it's worse. Just think of it as, okay, this should really go. It's a winning trade. It's going to add cash to my account. Most traders jump in with big trades when they see the numbers roll out with major variance. And that can be problematic because if it turns on you, you don't have any room to move and you've got to end up closing positions out for small losses, and then it starts to move. So smaller positions are easier to manage and easier to add to. So there's no hero trade here looking for the big hit winner, because I can tell you, I've been doing this for 33 years. It's a problem for many traders who go in boots and all, think they've got the answer, and there's other things can come into play. All right, guys, that's it from me. We've got some good things coming out to roll out very shortly, but just focus on these numbers. As I said, don't beat yourself up if you can't get to the numbers. As I said, even having a look an hour afterwards, see what the numbers come out, see what the move in the markets was. The easiest trade is definitely 5 or 10 minutes after. An hour afterwards could even be better. All right, guys, have a good one. All the best. Cheerio.